Good morning, dear learners, and welcome to the MOOC on Indian economy, pollution and environment. And we are in Module 9, Money, Banking and Prices, and now in Unit 4, Prices and Inflation. So here we will be briefly discussing about just a brief concept of retail inflation and the methodology adopted in India to measure inflation. Then we will be seeing the trend of inflation, particularly trend of general inflation. Then we also make a global comparison, and we will see the trend of food inflation. Then we will also analyze the price behavior of major consumer baskets in terms of price indices and factors behind the rising prices. Then we shall also analyze the price behavior of major consumer baskets in terms of rate of inflation. Then we will also be analyzing the structural drivers of inflation and inflation and policy responses. Then policy responses to inflation, evaluation and efficacy. Then we shall be concluding the unit, and we will be discussing also the policy recommendations. So, the basic consumer basket, comprising food staple, fuel, clothing, and essential services, has long been a critical indicator of economic well-being in India. For decades, a significant proportion of household income, over 45% in rural areas as of 2020, has been allocated to food expenditures, rendering price volatility in essential commodities a direct determinant of poverty, nutrition, and social equity in the country. Since gaining independence in 1947, India has navigated a tumultuous path from chronic food shortages to surplus production, yet inflationary pressures remain a persistent challenge. So in this unit, we shall analyze the evolution of consumer basket prices in the approximately last 8 decades since independence. Further, we shall also analyze certain structural bottlenecks and discuss the policy responses and requirements. So let us briefly view the concept of retail inflation, what it is. So retail inflation, also called consumer inflation, is a general rise in prices of consumer goods where a unit of currency effectively buys lesser goods and services, resulting in an overall drop in purchasing power in an economy over a period of time. More commonly, people refer to inflation as a rising cost of living. A prolonged period of inflation occurs when a nation's money supply growth outpaces economic growth. So generally, people's perspective on inflation differs based on their economic position. Those with tangible assets like property or commodities may prefer some level of inflation as that raises the value of their assets. People holding cash may not like inflation as it erodes the value of their cash holdings. A country always aims to maintain an optimal level of inflation to promote spending to a certain extent instead of saving, thereby nurturing economic growth. Now, what methodology we adopt to measure inflation in India? In India, the Reserve Bank of India uses consumer inflation as a key measure of inflation to set the monetary and credit policy. So, how it is done? So, consumer inflation is based on the Consumer Price Index, CPI. So, it measures the weighted average of prices of a basket of 260 goods and services which are of primary consumer needs, such as food, transportation, education, health, fuel, etc. Changes in the CPI are used to assess price changes associated with the cost of living. So prices of sample goods and services are collected every month from 1,000 to 1,200 urban markets and villages by field staff of Field Operation Division of NSO, MOSPI, and the changes, if any, is noted. The annual percentage changes in CPI is used as a measure of inflation, though from time to time we also analyze the monthly trends like that. So consumer price changes in India can be very volatile due to dependence on energy imports, the uncertain impact of monsoon rains on its large farm sector, difficulties in transporting food items to market because of poor roads and infrastructure and high fiscal deficit. So the current base year of CPI is 2012 with base value of 100. So the consumer price index basket comprising 260 commodities including certain services are grouped under 11 heads, broad heads. Their weightages in the basket is mentioned here as follows. So what are the weightages like that? Weightage of food and beverages is 45.86%, transport and communication 8.59%, health 5.89%, education 4.46%, housing 10.07%, fuel and light 6.84%, clothing and footwear it has 6.50% weightage, pan, tobacco and intoxicants it has 3.38%, household goods and services has 3.80%, recreation and amusement has 1.68%, and finally, personal care and effects have 3.89%. Let us briefly see an example of how this consumer inflation is calculated. So let's assume 1 kg of rice cost rupees 30 in the year 2000. Thus, rupees 300 could have fetched 30 kgs of rice at the time. But in the year 2020, 1 kg of rice cost 60, where 300 could fetch only 5 kgs of rice, okay, during this time. So, although the value of 300 remained the same, it lost its purchasing power by 50% over the 20-year period. Because earlier we could buy 10 kgs of rice, now we can, in 2020, we can buy only 5 kgs of rice. So, this phenomenon is called inflation. However, it is not necessary that prices always rise with the passage of time, as they may remain steady or even decline. So, using the same example above, if the price of rice is reduced to 15 kg in 2020 instead of 30 rupees in 2000, so the same 300 now would bake 20 kgs of rice. So, in this case, the purchasing power of currency has increased over the period as the price of commodity has declined. So, this phenomenon is called deflation, and it is the opposite of inflation. Now, let us discuss the trend of inflation. Okay, let us begin with the trend of general inflation, what it is. So, general inflation, also called as retail inflation or consumer inflation, is a broad indicator of the entire basket of consumer goods. So, in figure 1.a, we will see the monthly trends of inflation during 2024-25 for the months April to December, and in the next part, in panel B of the figure, we will see the annual trends of inflation for the last 10 years. That is from 2013-14 till 2023-24. So here in figure 1, trend of general inflation during April to December 2024 has been shown in panel A, and the annual rate of inflation during 2013-14 till 2023-24 has been shown in panel B. So figure 1A indicates the retail inflation decreased from 5.2% in December 2024 from a higher level of 6.21% in October 2024. On year-on-year basis, inflation gradually came down from 10.01% in 2013-14 to 3.40% in 2018-19. Okay, it can be seen in panel B of the figure 1. So, however, after that, it continued to rise during the COVID-19 pandemic period. It touched a higher level of 6.18% in 2020-21, which came down in the next year. However, it again rose to 6.66% in 2020-23, and in 2023-24, it has come down to 5.36%. Now, let us make a global comparison. So, in today's globalization world, another way to interpret a country's performance in managing inflation is to get a comparative view among other countries. So, in table 1, we can see the general inflation rates of some of the major G20, Group 20 economies, including India, during the years 2013, 18, and 2023. So, here is the table, and here we can see the general inflation rates of the countries like India, Turkey, Russia, Indonesia, Brazil, South Africa, China, Australia, UK, USA, France, and Japan for the years 2013, 18, and 2023. So, from table 1, it can be seen that from a peak of 10% in 2013 to a low of 3.4% in 2018, India's inflation rate reduced globally, gradually before starting to grow slowly once more in 2023 to reach 5.36%. India's inflation in 2023 is lower than that of Turkey, the UK, South Africa, Australia when compared to 11 of its benchmark G20 rivals. But it's higher than China, Japan, Indonesia, Brazil, France, and the United States. So for a nuanced understanding of the impact of inflation on an economy, we need to look beyond the general inflation rate. So we shall analyze the context of food inflation in India in the recent times. Now, examining the trend of food inflation, we will see that food inflation is based on the Consumer Price Index, CPI, we have already told about this, which measures the changes in retail prices of food items consumed by the population. Study of food inflation is important for India, as a large section of the population still live below the poverty line. Thus, study of food inflation provides the broad picture of extent of hardships the common people have to suffer because of the general inflation. The weight of CPI commodities is 39.05% on the entire CPI basket. Now, figure 2A, we will see the monthly trends of food inflation during 2024-25 for the months of April to December. And in the alongside part B of the same figure 2, we will see the annual trends of food inflation for the last 10 years from 2013-14 till 2023-24. So here in figure 2, we will see trend of food inflation during April to December 2024 in panel A and the annual rate of inflation during 2013-14 till 2023-24 in panel B. So from figure 2A, it can be seen that food inflation decreased to 8.39% in December 2024 from 9.04% in November 2024. Prices of vegetables increased by 26.56%. And the cost of pulses increased by 3.80%. This is quite similar to the pattern seen in figure 2A. Now, figure 2B shows food inflation rate on year-on-year basis in 2013-14. So, it can be seen that food inflation is reflecting a similar pattern we noticed in case of general inflation as shown in figure 1B. The annual food inflation, which was 11.04%, gradually came down to 0.17% in 2018-19. Okay, we see it in figure 2B. However, after that, it continued to rise during the COVID-19 pandemic period. It touched a higher level of 7.77% in 2020-21, which came down in the next year. However, it again rose to 6.60% in 2020-23. In 2023-24, it has further increased to 7.48%. Now, let us examine the price behavior of major consumer baskets in terms of price indices. So, table 2 shows the price behavior of 6 major consumer baskets along with consumer price index (CPI) and consumer food price index (CFPI) during the period 2013-14 till 2024-25. Please note that the CPI shows the overall price trend in the economy, while the CFPI reflects the changes in the prices of consumption basket. The CFPI shows the price behavior increasing or decreasing in the consumption basket. So, here in table 2, we show the price behavior of CPI, CFPI and the items in the major consumer baskets. Okay. So, in table 2, this data has been shown in figures 3 and 4. Okay. So, figure 3 shows the trend of CPI and CFPI, while figure 4 reflects upon the price behavior of 6 major commodities of the consumption basket. These 6 commodities include health, housing, food and beverages, transport and communication, fuel and light, and pan, tobacco and intoxicants. Okay. Please note that this data are annual average basis. These are annual rates. So from figure 3, it can be seen that there is an increasing trend in case of both CPI and CFPI. However, the CFPI has remained higher than the CPI throughout the period. So during this period, CPI has increased by 71.66%, while the CFPI has increased by 74.81%. It should be noted that particularly since 2018-19, the gap between the two has been increasing, indicating the CFPI has increased at a higher rate than the CPI. So in 2013-14, the gap between the two was 3.7%, which has increased to 10% in 2024-25. Now, to understand which commodity basket are propelling this rising trend, let us consider figure 4. So figure 4 shows the pattern of changes in the CPI in the commodity basket during 2013 to 2024-25. So thus, we can see that over the period, CPI in health increased by 80.42%. CPI in housing has increased by 66.67%, food and beverages by 74.74%, transport and communication by 56.09%, fuel and light by 59.90%, and pan and tobacco and intoxicants by 84.86%. So, if we analyze the factors behind these rising prices, okay, we will see that from the above data, it can be seen that pan, tobacco and intoxicants, health and food and beverages are the 3 major commodities in the commodity basket that are propelling the price indices of the CFPI. Now, among these, pan, tobacco and intoxicants has been subject to higher tax rates as always. So, currently 28% GST is charged on these products. Other than GST, NCCD, National Calamity Contingent Duty, to the tune of 2 to 3 to 6 to 9%, excise duty of 5 to 10%, and 5 to 6% are imposed on these products. Organizers like WHO has recommended to impose taxation rate to the tune of 75% on these products. Now, if we see the increasing cost of healthcare is a significant concern in India, okay? And the Eco India Health Insurance Index 2024 reports that as in September 2024, medical inflation in India stands at 14%, which is highest among the Asian countries, including China. The study has shown that about 23% of hospital expenses are funded through loans, while 62% are paid out of pocket, creating significant financial stress on the Indian population. So medical inflation is driven by the factors like technological advancements, increased demand for medical tourism, rising instances of chronic illness, growing demand for quality healthcare, and shortage of healthcare professionals. As the study mentions, the post-COVID-19 era has seen a rise in chronic illness, affecting 35% of respondents in India Wellness Index 2023, further rising treatment costs. So, a shortages of healthcare professionals, especially in rural areas, exacerbate this issue. Consequently, health insurance premiums are rising, with increase of 10 to 20% every 5 years, disproportionately affecting older adults and those with pre-existing conditions, leaving low-income groups struggling for adequate coverage and escalating healthcare costs. Now, with regard to food inflation, a study published in Reuters on June 21, 2024, undertaken by Rajendra Yadav, has shown that food inflation in India remained high at around 8% on year-on-year basis in November 2023. This study outlined the factors primarily driven by supply-side issues like adverse weather conditions impacting crop yields, which was adversely affected by drought conditions faced in 2022 and heat waves in 2023. Despite early monsoon rains and above normal rainfall forecast for the year 2023, inflation persisted as elevated food prices, accounting for nearly half of consumer price basket, kept overall inflation above the central bank's 4% target, hindering interest rate cuts. The severe heat, on the other hand, with temperature of 4.9 degrees Celsius above normal, has spoiled stored vegetables and hindered crop planting, particularly for pulses and common vegetables. Export curbs and tariff reductions on imports have not sufficiently alleviated the situation, worsening the vegetable supply shortage as farmers face disruption in planning. The retail inflation situation faced by India in 2024 compared to the previous year may be viewed from figure 5. So from figure 5, it indicates that food inflation has been primarily driven by vegetables. Okay, so in figure 5, we can see the rising inflations in items like fuel and light, transport and communication, housing, milk and products, then clothing and footwear, then prepared meals, snacks, then health. Then we also compare the India's general inflation rate with all these items. And also we will see the food and beverages, cereals and products, and vegetables. And we see that in vegetables it is the highest, 27.30%. So there is no doubt that high food inflation is a major concern in India, particularly given that food comprises 45.9% of the consumer price index basket. A study published in Economic Times, October 14, 2024, has analyzed that the price increase in tomatoes, onions, and potatoes, we briefly call it TOP, has significantly affected food inflation in India. According to the study, these three vegetables, though accounted only 4.8% of food and beverages and 2.2% of overall CPI, yet due to high price volatility significantly impacted retail inflation in the country. Factors such as soft crop cycles, perishability, regional production concentration, and climate-related supply chain disruptions were behind the rising of TOP prices. Seasonal supply shortages led to inflated prices, while bumper harvests forced distressed sales. However, despite challenges, India's production of TOP has surged in the recent times, 2020-23 estimates showing it is the second largest tomato and potato producer and the largest onion producer globally. Another way to analyze the price behavior in consumer basket is to examine the trend of average annual rates of inflation. Okay, so let us consider this price behavior in terms of rate of inflation. The annual rate of changes in CPI, CFPI, along with rate of inflation or deflation, as the case may be, in the major consumer baskets has been shown in table 3. So here in table 3, we see the items like consumer price index, CPI, health, housing, food and beverages, transport and communication, fuel and light, then pan, tobacco and intoxicants, and also the Consumer Food Price Index, CFPI. So from table 3, we can capture the trend of CPI and CFPI as shown in figure 6. So from the figure 6, it can be seen that unlike a steady pattern of CPI and CFPI as shown in figure 3 earlier, a zigzag trend between the two is noticed in figure 6. So in certain years, the annual rate of increase in CPI is above CPFI, and in other years, it has just reversed. So noticeably in 2018-19, the CFPI was significantly lower than the CPI. However, recently, in the last 2 years of 2023 and 24-25, annual rate of increase in CFPI has remained above the Consumer Price Index, CPI. So the trends of inflation in the major consumer baskets have been shown in figure 7. Okay, so from the figure, it can be seen that the 6 consumer baskets reveal varying trends. For example, pen and tobacco products had the highest inflation during the years 2014-15 till 2017-18. After that, it came to a comparative lower level. However, in 2020-21, it again recorded the highest inflation rate in the consumer baskets along with transport and communication, reaching nearly 10%. So the rise in inflation rate in the transport and communication during the 2020-21 can be attributed to COVID-19 pandemic as people stranded outside the home state were striving to return home at any cost. So another significant finding of the study is that across the entire period, fuel and light recorded the peak inflation rate of 11.3 and 10.4% in the 2 consecutive years of 2021-22 and 2022-23. Quite significantly, the inflation rate in this segment also recorded a negative rate of minus 3.1% in the recent year of 2024-25. Studies attribute this negative inflation to the factors like a sharp decline in global energy prices and government interventions like price cuts in LPG, petrol, and diesel. Further, in the recent 2 years, food inflation rate has been the highest in the consumer baskets. These baskets has witnessed high volatility as inflation rate in this sector varies between 0.7% to 7.6%. Another important point to note here is that inflation rate in the health, which we already mentioned as medical inflation, has throughout this period increasing trend in the range of over 4% to over 7%. So in fact, in 2 years of 2017-18 and 18-19, inflation rate in this segment was the highest in the consumer basket. Now, let us see the structural issues that drives inflation in India. So in the Indian scenario, we see 3 structural primary drivers of inflation are there. First is agricultural dependence on monsoon and vulnerability. Agriculture, employing 45% of the workforce, remains monsoon dependent. The 2014-15 drought reduced pulses output by 2 million tons, spiking prices by 38%. Climate change exacerbates risk, with extreme weather events projected to reduce GDP by 3% by 2050, as per estimates of World Bank. Then global commodity linkages. So India imports 85% of its oil and 56% of edible oils, linking domestic prices to volatile gold markets. The 2022 Ukraine conflict disrupted sunflower oil supplies, inflating prices by 40%. Then finally, wage price spiral. Real wage growth, averaging 7.3% annually between 2005 and 2015, increased production costs, particularly in labor-intensive sectors like construction. So now let us examine that inflation and policy responses. Okay, let us see first the temporal analysis. So in this section, we shall try to analyze India's inflationary history across approximately the last 8 decades since independence, contextualizing the shifting paradigms of policy responses from state-led controls to market-oriented reforms and their socio-economic ramifications. So drawing on statistical data, archival records, and contemporary research, we shall try to assess India's successes in taming hyperinflation and the unresolved challenges of structural inflation. The post-independence period in India, 1947 to 1965, was characterized by severe supply shortages due to colonial exploitation and the partition, disrupting agrarian supply chains, particularly in regions like Punjab. By 1951, food grain production was only 50.8 million tons for a population of 361 million, with per capita availability of 137 kg per year, lower than the pre-independence levels. The government enacted strict price controls via Essential Commodities Act 1955, but bureaucratic inefficiencies hindered private investment, worsening shortages. The first two 5-year plans, focusing on heavy industries, sidelined agriculture. We have discussed this earlier as well. So this resulted to a 6 to 7% average inflation in the 1950s, which increased to approximately 10% during the drought years, 1965 and 1966. So from 1965 to 1980, particularly the Green Revolution, transformed agriculture with high-yielding crop varieties, fertilizers, and irrigation. Wheat production surged from 12.3 million tons in 1965 to 36.3 million tons by 1980, stabilizing food prices, but benefits were uneven, favoring certain states only. The 1970s faced global oil shocks, with rising oil prices exacerbating inflation. By 1980, the government expanded the public distribution system, PDS, as we have already discussed in earlier units as well, making subsidized gains accessible to 80% of India's population. However, fiscal deficits reached in the range of 5 to 6% of GDP in the mid-1970s, fueling inflationary pressures. So the 1980s marked a shift toward populist policies under the Indira and Rajiv Gandhi's regimes, expanding welfare schemes but increasing fiscal imbalances with an average fiscal deficit of 78% of GDP in the decade, accompanied by a high inflation rate which peaked to 9.4% during the period. Agricultural stagnation worsened as dependence on imports for pulses and oilseeds grew, culminating in a balance of payment crisis in 1991 that promoted economic liberation in the country. Now, the new economic policy, NEP, introduced in 1991 by the Finance Minister Manmohan Singh, initiated significant economic reforms by dismantling the license rush, abolishing industrial licensing, and inviting foreign investment to the country. This led to fiscal consolidation, reducing the fiscal deficit from 8.4% of GDP in 1991 to 4.1% by 2000. Further, trade liberalization also slashed import tariffs as weighted average tariffs fell from 87% approximately in 1990 to 25% approximately in 2000, from as high as 128% in certain commodities in the reform period. So inflation rate stabilized with WPI, Wholesale Price Index, averaging 5.2% from 1991-2000, down from 8.3% during the 1980s. Nevertheless, globalization brought challenges like the 1997 Asian financial crisis and the 2002 drought, which raised food inflation to 7.1%. The RBI adopted a multiple indicator approach in 1998, and by 2004, forex reserves reached $141 billion, providing a buffer against external shocks. The mid-2000s saw GDP growth averaging 7.5%, but supply-side bottlenecks and global commodity price surges caused inflation in the economy. The 2007 global food crisis led to significant increase in wheat and edible oil prices. Consumer price index inflation peaked at 9.7% from 2009-13, largely due to protein-rich foods. The RBI responded by raising the repo rate 13 times between March 2010 and October 2011, and the repo rate during the period was increased cumulatively by 375 basic points, from 4.75% to 8.5%. Meanwhile, the National Food Security Act of 2013, while expanding subsidized grain coverage, distorted cropping patterns. In 2016, a flexible inflation targeting FIT framework was set, aiming for CPI inflation at 4% plus minus 2%. We have discussed this in earlier unit as well. Now, structural shocks like demonetization in 2016 increased vegetable prices in the range of 15 to 20% during the period of late 2016 and the early 2017. So, the COVID-19 pandemic exposed systematic vulnerabilities. Lockdowns disrupted harvest, migrant labor flows, and transportation pushes consumer price index to 7.6% in 2020. Pulses and edible oil surged by 16.7% and 13.4% respectively due to import delays and hoardings. The RBI responded with liquidity injections of 6.7 lakhs crore in the economy and a 115 basis point reported cut, but supply constraints limited its efficacy. Now let us look into the evolution and efficacy of the instruments of these policy responses to inflation. First, let us view the monetary policy. The RBI's transition from monetary targeting in 1980 to FIT, flexible interest target, in 2016 marked a shift towards transparency. While FIT reduced inflation volatility, food supply shocks often necessitated trade-offs between growth and stability. Second is the supply side reforms. Initiatives like the National Agricultural Market (ENAM) and PM Kisan Samman Nidhi aimed at improving market access and farmers' income. However, only 20% of farmers use ENAM due to infrastructural gaps. A study of Niti Aayog has shown this. Now, fiscal measures. Subsidies on food and fertilizers and fuel remain contentious. The food subsidy bill ballooned from 24,000 crore in 2000 to 5.4 lakh crore in 2023, straining fiscal responsibility of the government. Other major government initiatives include the public distribution system, PDS, we are talking about this, despite leakages and inefficiencies, has played a vital role in averting famines and stabilizing grain prices in the country. While diversion rates reached 40% in 2000s, digitalization, Aadhaar card integration has reduced it to 20% by 2020. Buffer stock managed by the Food Corporation of India have often exceeded operational requirements, incurring massive carrying costs of 1.7 lakh crore in 2020 for stocks 3 times the mandatory level. So direct benefit transfer such as PAHAL scheme for LPG subsidies improve targeting but face challenges in excluding genuine beneficiaries, particularly in rural areas in the country. Now we come towards the conclusion of policy recommendations of this unit. So India's consumer price trajectory, we have seen India's consumer price trajectory over 7 decades reflects the interplay of agrarian legacies, globalization and policy experimentation. While economic reforms and technological advancements have mitigated extreme volatility, structural challenges, climate vulnerability, supply chain inefficiencies, and policy distortions persist. It is significant to note that though general inflation rate in India has come down significantly compared to the levels a decade back, yet when we see some concern when we analyze the case of food inflation. This situation becomes worried when we consider inter alia facts we have already tackled in the previous discussion, in the previous units of the course, particularly relating to distressed migration from agriculture, rising unemployment, a distressed job market, etc. Thus, essentially, the RBI's FIT policy, though might seem to have performed satisfactorily in terms of the general inflation rate, keeping it in 4% bracket, plus minus 2, yet when we consider the food inflation thing, the situation is quite worrisome. In fact, in the long run, such a trend has the potential to adversely affect impoverishment and rural poverty in the country. Thus, to ensure affordability of food security, future strategies must prioritize agricultural diversification, incentivizing millets, pulses, and oilseeds through revised MSP mechanisms. Investments in cold storage infrastructure and farmer-producer organizations can reduce post-harvest losses, while climate-resilient cropping patterns and expanded crop insurance can buffer against monsoon uncertainties. And rationalizing subsidies through targeted nutrition support rather than universal PDS would enhance fiscal sustainability. By addressing these imperatives, India can stabilize prices for its vulnerable population and build a resilient food systems for the 21st century. So with this, we come to the end of the unit, and in the next unit, we shall start a new model on public finances. Till then, happy learning. Thank you.